If you're trying to buy a home in 2026 and you're wondering if you can qualify for a conventional loan, well, then this video is for you. We're going to break down the qualifications in plain English. We're going to talk about credit. We're going to talk about down payment. We're going to talk about income and job history. We're going to talk about debt to income ratio, mortgage insurance, and loan limits. And we're going to talk about the stuff that a lot of times people don't talk about until it's too late. And then I'm going to give you a quick update at the end because there's a change that started in late 2025 that matters if you're buying in 2026. And it's one of those things that sounds really good on the internet, but it requires a reality check, and it has to do with Fannie Mae. But before we get started, I want to talk about what a conventional loan actually is. A conventional loan, simply put, is a loan that is not backed by the federal government like the FHA and the VA loans are. Most conventional loans are going to follow the same guidelines as Freddie Mac and Fannie Mae. And you may ask, well, what does it matter? Well, it doesn't really matter. What does matter is that conventional loans are going to reward strong borrowers, like those who have low debt, a high credit score, and a large down payment. So if that's you, then a conventional loan could be the best out there in the mortgage world for you. But at the same time, you don't have to have a super high credit score to qualify for a conventional loan. You don't have to have, super low debt, and you don't have to have a extremely large down payment. What it does is that it rewards those strong buyers who do have those qualifications with a lower interest rate. And it separates those from the ones that are just kind of mediocre. But either way, if you're wondering whether or not conventional loan is the best way to go for you, after watching today's video, you're going to know. Now, when it comes to a conventional loan, there are 5 pillars for loan approval. Think of it like a 5-part scorecard. They're going to look at your income and employment history. They're going to look at your credit profile. They're going to look at your income and your assets. They're going to look at your debt to income ratio, and they're going to look at the property and the size of the loan, which is basically loan limits. And that's really the gist of it. But before we get started, I'd like to take a moment and ask a favor. So if you find any value at all in the videos that I make, then I'd like to ask you to hit the thumbs up button and, consider subscribing to the channel so that you could stay up to date on everything real estate related. So one of the big questions that comes up when you're talking about possibly getting a loan is, how long do I need to be employed? How much job history do I need? How much money do I need to make before I start to apply for one of these loans? So I want to start with talking about employment and job history. There's something called the 2-year stability rule. In general, lenders want to see a 2-year stable income and stable employment. Now, that doesn't mean you can't change jobs. It just means that you can't look like a financial roller coaster. Usually changing jobs is not a big deal as long as you stay in the same line of work. So if you were in sales, you're still in sales. If you were in management, then you're still in management. If you were an electrician, then you're still an electrician. What they don't want to see is you go from, working at a job where they give you a W-2 and they pay your income, and you're working for somebody else, to going to self-employed. And, you did that last month, and now this week you want a loan. And that's because most of the time, if you're self-employed, lenders want a 2-year history of a reliable self-employment income. And that's because consistency matters more than the amount. There's no minimum or maximum for the requirements for a conventional loan. You can make $50,000 a year, or you can make $500,000 a year. What matters is they want to be able to, document a history of consistent income. If your income is trending up gradually, that's usually fine. What is a problem is if your income is inconsistent. Say you're making $50,000 one year, and the next year $150,000, next year $75,000, next year $200,000. That's when they start asking, uncomfortable questions. So just to reframe it, you need stability in your employment and your income for a conventional loan. When it comes to minimum credit requirements, your credit score, the classic rule is that you need a minimum of a 620 to qualify for a conventional loan. In the real world, you want your credit score to be a bit higher. And the reason is a lot of the lenders will have what's called overlays on their programs. So they will say, okay, you need a minimum score of 620, but we are going to ask you to have a little bit higher credit score, like a 640 or maybe a 660. And the reason they do that is just to protect themselves. They are, looking at your credit score, and the fact is that if your credit score is a bit higher, then you are less of a risk for them. They're just trying to protect themselves and make sure that you qualify for the loan. If you have a very low credit score, then you are at a higher risk to them when they're making the loan to you. So if you're sitting at, like a 620 credit score, maybe a 630, you technically qualify for a conventional loan. But, the terms could be ugly, and, approvals can be a little bit harder to get. And so my advice to you would be to go ahead and try to improve your credit score. And it's not just about getting approved, it's about a better mortgage payment. You're going to get a better mortgage payment, you're going to get a lower PMI, better interest rates, and, that's going to be great for the mortgage. Now, when talking about credit scores, one thing happened where, and I'm going to explain it later in the video, where Fannie Mae in late 2025 stopped requiring a 620 credit score on some of their files. Now, is that true? Yes, it is true. And it did happen, and a lot of people are talking about it. Now you can go and get a loan, and everybody can have a loan with no credit score. The truth is, you need a credit score, and you're still going to probably need a minimum of 620. I'll explain it later in the video. Now let's talk about the third pillar on that scorecard for qualifying for a conventional loan, which is the down payment. You can qualify for a conventional loan with as little as 3% down for a conventional loan. Now, the myth out there is that you need 20% down for a conventional loan. The truth is that you can qualify for a conventional loan with as little as 3% down for a primary residence. So one of the questions that people ask is, can I put a larger down payment down? And the answer is yes, absolutely. You can put 5%, 8%, 10%, even 50% down. There is a minimum, not a maximum. But what you want to focus on is that if you're putting the minimum down, then a conventional may not be the best way to go. Sometimes the payment can be better if you're putting the minimum down, and that PMI on a conventional loan can be pretty expensive. So sometimes the FHA may be better as far as a mortgage payment goes. So you're not going to want to let your lender decide which way you're going to go. You're going to want them to give you some options, and then you choose which one is better. And hopefully they can explain everything to you in an easy way for you to understand exactly what all the details are between a conventional loan and an FHA. If you're making that minimum 3% down, there could be some better option for you with FHA. Now, if you're using a conventional loan and you're putting less than 20% down, then what you're going to pay is the private mortgage insurance, PMI. Now, what private mortgage insurance is a payment that is going to protect the lender if you default on the loan. A lot of people think that maybe this is an insurance that protects them. No, it is actually an insurance that protects the mortgage company in case you default on the loan. And so what that is, you are a higher risk to them if you cannot put 20% down. So, you need to look at the options if you're going with a conventional loan and trying to put less than 20% down. Because, like I said before, the FHA loan may be a better fit for you if that's the case. Now, there are advantages and disadvantages to the FHA loan. Your mortgage payment may be a little bit smaller if you're putting less than 20% down, but with an FHA loan, the mortgage insurance will not go away for the life of the loan. So the payments may be less, but you're going to pay them for the life of the loan. In the case of the conventional loan and private mortgage insurance, if you when you get to the point where you have 20% equity in your home, and that may require an appraisal, or maybe you just call them, or maybe it happens automatically, but you need to check into that, how that happens if you're getting into the conventional loan. But anyway, when you get to that 20% equity, then your private mortgage insurance comes off of that payment. So, advantage, disadvantage, it depends. So that's why you need a professional loan officer who can tell you all those details so that you can go over everything and figure out what's best for you. Now let's move on to the next pillar on that scorecard for the requirements for a conventional loan, which is the debt to income ratio. Now this one is the most misunderstood pillar or scorecard on these requirements. And the debt to income ratio is basically all of your debts divided by your gross take home pay, not your net take home pay, but your gross pay. So how are lenders calculating your income? Well, if you're a W-2 employee, they're going to look at the past 2 years and they're going to average that income out. And if you are a self-employed person, then it's going to be more document heavy. They're going to need proof. And now what are they considering as debt? When they're looking at DTI, what are they considering debt? Well, they're going to look at what shows up on your credit report, stuff like car payments, personal loans, school loans, that kind of stuff. And that what they're not looking at is your grocery bill, your childcare bill, what you're spending on Amazon. That's not that's not their problem. That is a budget problem for you. So with that being said, there is a front end debt to income ratio and a back end debt to income ratio. On the front end debt to income ratio, you got the housing costs, which is your principal and interest, your insurance payments, and stuff like HOA payments. That is your front end debt to income ratio. So you take that, let's say it's $3,500 and you're making $10,000 a month, $120,000 a year divided by 12, that's $10,000 a month. So you take the $3,500, which is your front end debt on the house, and you divide it by 10,000, and that's 35%. That's your front end. Now, when you're talking about the back end, you're talking about all the stuff added to your front end that comes up on your credit report, such as, car payments and loan payments and student loans and stuff like that. So let's just say your car payment is $500. You got the other loans that add up to approximately $1,000, not approximately, $1,000. So you're talking about $3,500 per month. And then you add on the $1,000 in the stuff that shows up on your credit report. That is $4,500 per month divided by the 10,000, and that's 45%. Now, with a conventional loan, that's what you want to shoot for. A lot of the requirements show that you want to be right around 45% when it comes to debt to income ratio. Some of the requirements will go up to as much as 50%. It actually shows that you want to be 49.9% or less when it comes to debt to income ratio. So in some cases, you can still get approved with a higher debt to income ratio, depending on, certain factors. What are those factors? Basically you're looking at if you are a lower risk, if you have a higher down payment, you got a higher credit score, you got more money in the bank, you got some reserves. It basically, if you are a strong bet, then the underwriters are going to be more flexible and you're going to get approved a little bit easier if you're a good bet for them. If you're a high risk, it's going to be a little bit tougher to get approved. So earlier in the video, I talked about, a new rule for Fannie Mae, where in 2025, late 2025 in November, Fannie Mae is no longer requiring a minimum credit score of 620. That is true, and they did come out with that. And what does that mean? Well, what it doesn't mean is that no credit, no problem, here are your keys, you got the loan. No, that's not the case. What they're doing is they're looking at a broader spectrum of your file, and they're looking at things like your work history and your income history, your down payment, and other things other than just a third-party credit score. The realistic change is really that, yes, there is no more requirement, a straight line requirement for a third-party credit score, but most lenders are talking about still requiring, looking at your file and looking at the broad file and saying that you need, like I talked about, you need to still be a strong borrower. You need to have steady income, large down payment. You still need a good credit score, and all the same things that we've been talking about the entire video. Now, if you're somebody out there looking to get pre-approved and you want to know what will I actually need? Okay, so first I want to talk about the difference between a pre-qualification and a pre-approval. A pre-qualification is just a conversation. You call somebody on the phone and you have a conversation. Let's say, I make $80,000 a year and I want to put 3% down, and they take that information and say, okay, you're qualified for this much house. A pre-approval is you have that same conversation, and then the loan officer will ask for documentation. They ask for the documentation. You give them proof of your income and all of what we talked about, and then they give you a more detailed. They run your credit and they give you a more detailed approval, and they show you exactly what you can afford for a home. So if you're out there, you're serious about buying a house, you're looking at homes and you're wanting to make an offer, what you want is a pre-approval letter, because you don't want to get down the line after you've made the offer and you're in underwriting and you're in that process, and then underwriters are starting to ask the hard questions that you didn't ask in the pre-qualification, and you didn't get all the proof, and maybe you don't have it, and now everything falls apart. You've fallen in love with the house, you really want this one, you put the offer, you're really serious, and now you're in a bind because you didn't get the right pre-approval. Look, if you want to get taken care of professionally, reach out to me. My contact information is in the description. I'd be happy to help you go through this process as smoothly as possible. And anyway, give me a call and I'll take care of you. So what are they actually going to ask for as proof, as documentation, when the lender is trying to get you pre-approved? They're going to actually ask for 30 to 60 days of pay stubs. They'll probably ask you for W-2s the last 2 years. They're going to ask you for tax returns. They're going to ask you for bank statements, 2 to 3 months of bank statements. They're going to ask you for photo ID and that kind of stuff. So it gets real detailed, and they're going to make sure that you qualify and are approved for that specific loan. And they're going to ask for all those documentations. It's going to feel real personal because it is. And they are wanting to protect themselves and make sure that that what you're saying is actually true. So they're going to want proof. Now, I realize that a lot of you watching this video may also be considering an FHA loan. So let's talk about the differences between an FHA loan and a conventional loan. The biggest advantage to a conventional loan versus an FHA is the PMI insurance. So I talked about it before, the private mortgage insurance that you have to have if you are going with a conventional loan and you're not putting 20% down. The advantage is that those payments will be lower for stronger borrowers. If you've got a strong case, all the stuff we talked about, better credit score, then you are going to get a lower private mortgage insurance payment. And the biggest advantage is after you get 20% equity in your home, that private mortgage insurance is going to be able to come off of that loan. So that is the biggest advantage for conventional. Another benefit is, I said it just a minute ago, is that conventional loans are going to reward those borrowers that have a strong situation. They have a high credit score, they have extra funds, they've got a big down payment, and so therefore you're going to get a better rate. Where FHA may be better for some of those borrowers who are only able to pay the small down payment and their credit score is kind of iffy. The downside of that is, the mortgage insurance is more than likely going to be lower than private mortgage insurance on a conventional loan. With an FHA, it'll be a little lower, but it is for the life of the loan. So that's why you need a great lender who is going to look out for you, and so that they can explain to you all these situations and which one is better for you. So if you want to be taken really good care of, give me a call. My contact information is in the description. I'd be happy to point you to a great loan officer who is going to take really good care of you and let you know what those options are. So one of the biggest mistakes that I see people making all the time is not starting that conversation early, not not reaching out to the loan officer. If you are thinking about buying a home in 2026, then the best thing that you can do is to get in touch with a loan officer. Give me a call and I'll put you in touch with them. And, not because you need to be in a rush, but because you maybe you need to work on some things. Maybe you need to see what the scenario is, see what the situation is, and have time to work out that situation and still be able to buy in 2026. Start that conversation early. Look for and find a really good loan officer who can help you through this situation and work through the details and let you know what you need to be working on. Or maybe, everything's great and you're ready to go, and we can start looking for houses and get you on that process, get you into that process and start looking for houses, which is really a lot of fun, and I'd love to help you do that. So if you gained anything from this video, or maybe you like this type of content, hit the like button, subscribe to the channel so that you can be the first to know about the current market conditions in the area and in real estate. Thanks for watching, and I'll see you on the next video.